Donald Trump has not refuted Bloomberg's inside report about the phased introduction of tariffs, as he did with the Washington Post story. As a result, markets managed to catch their breath and shift focus to the US inflation reports. However, experts predict that the impact of these metrics on the currencies may be short-lived. Even officials from the Federal Reserve acknowledge that making reliable predictions about the future trajectory of inflation is currently highly challenging. The odds are that Donald Trump could unleash a wave of executive orders after his inauguration. Many of his campaign pledges were intended to be fulfilled by the very first day of his presidency. This means that as early as the next Monday, January 20th, he could make high-impact decisions. For instance, according to the Washington Post, Trump plans to sign documents related to the cryptocurrency sector on his first day in office. This may include declaring Bitcoin as a U.S. reserve asset. The highlight of the economic calendar this week is the U.S. inflation reports. Following weak producer price data, the U.S. dollar was forced to retreat further from its two-year high recorded on Monday. Its index against a basket of 6 major currencies consolidated within a narrow range of 100.10 to 110.20 as markets awaited the U.S. CPI report. Factory inflation in the U.S. rose from 3 to 3.3%, though it fell short of forecasts. Meanwhile, today's data on consumer inflation aligned with the expectations, accelerating to 2.9% year-over-year. This matches the levels last seen in June 2024. Combined with a recent sharp increase in the U.S. employment, today's statistics further limit the Federal Reserve's scope for additional rate cuts. Conversely, core inflation in the U.S. edged down from 3.3% to 3.2%, offering a glimmer of a hope for currencies competing with the U.S. dollar. Interestingly, the most impactful news for the euro today was the lack of the Donald Trump silence of Bloomberg's report, suggesting the U.S. might introduce phased tariffs. Now that's relief, euro traders might say. While they may not have rushed to buy the euro, they at least stopped aggressively selling the single currency. Adding to the optimism for the euro was a hawkish remark from an ECB policymaker. Robert HOLZMANN from Austria noted that the past two rate cuts may not be as straightforward as it seems. He pointed out that core inflation is currently closer to 3% than a key target of 2% and that energy-related issues could influence the ECB's future policies. Moreover, the US dollar weakened while the British pound stabilized, which also lent support to the euro. As a result, the single currency managed to rise slightly overnight, giving the bulls an opportunity to stage a correction around 1.0300 against the dollar. The nearest technical resistance levels have shifted to 1.0350 and 1.0405. As for the support area, the critical level for the euro remains at 1.01. A break below this threshold would likely bring the pair to parity and further down toward 1.0950. While the short-term outlook allows for a potential upward attempt to test 1.0305, the selling pressure on the euro has not disrupted, and thus the euro-dollar pair is expected to remain within its downward channel. Oil prices opened with a correction today, and their further dynamics are largely influenced by the US inflation data, but not exclusively. Reports from the American Petroleum Institute showed that crude oil reserves decreased by 2.6 million barrels over the past week. This supported crude oil prices as the market awaits the official report from the Department of Energy later today. Besides, traders are still trying to assess the potential impact of the US sanctions on the Russian energy sector. As a result, crude oil is showing a modest yet steady increase. For instance, the benchmark Brent crude is holding within the range of $79.60 to $80.60. Following the US CPI data, oil prices are likely to remain near $80 per barrel. The sanctions factor is likely exerting pressure on the Russian ruble. Its negative impact is expected to intensify over time because it dials down foreign currency inflows into the country. For instance, according to reports from some US agencies, India and China are refusing to accept sanctioned oil tankers carrying Russian oil. At the same time, analysts suggest that the ruble is weakening due to the geopolitical factors and reduced supply of a foreign currency from the Bank of Russia compared to December. However, starting mid-January, some Russian companies are expected to prepare for the tax period by selling additional volumes of a foreign currency in the market, and this could help the ruble partly recover its January losses. That's all for now. We continue to follow developments in the financial market. Subscribe to our channel and follow news with us. See you.